Banks want you to miss a payment. Not by a lot, just once, just late enough to trigger a fee. And if that sentence makes you uncomfortable, good, because that discomfort is the entire business model hiding behind the piece of plastic in your wallet. Here's the number that should stop you cold. The average credit card interest rate sits north of 20% a year. Meanwhile, the same bank pays you less than 0.5% on your savings account. That gap isn't an accident. That gap is the business. So how does a piece of plastic that feels like free money end up being one of the most profitable products a bank will ever sell you? And today we're breaking down exactly why banks are obsessed with getting you a credit card, because it has almost nothing to do with convenience. Subscribe if you want more videos exposing what's really happening behind everyday financial products. Let's start with the uncomfortable truth. If everyone paid their credit card balance in full every single month, credit cards would be a mediocre business for banks. Here's what most people don't realize. Banks don't actually want you to default, but they desperately want you close to the edge. Step 1. The minimum payment is a trap disguised as a convenience. When your statement shows a tiny minimum payment option, it feels responsible to just pay that. But here's the math nobody shows you. If you have a $5,000 balance at 22% interest and only pay the minimum, it can take over 15 years to pay off, and you'll pay more in interest than the original amount you borrowed. The minimum payment isn't a safety net. It's a slow-motion trap that keeps the debt alive as long as possible, because every extra month you carry a balance is another month of interest flowing straight into the bank's pocket. Step 2. Rewards and cash back aren't generosity, they're bait. Think about why a bank would hand you 2% cash back or airline miles for spending money you were going to spend anyway. It's because rewards programs increase how much people spend and how often they reach for that specific card instead of paying with cash or debit. Banks have found that cardholders who chase rewards tend to spend more overall, and a small percentage back on purchases costs the bank far less than what they make from interest, fees, and the increased spending those rewards encourage. Step 3. The grace period exists to make debt feel invisible, not free. You've probably heard that if you pay your statement in full, you avoid interest entirely. That's true, and it's also intentional design. The grace period creates a psychological gap between spending and paying. By the time your bill actually arrives, the emotional connection to that purchase has faded. You're no longer feeling the moment you bought something. You're just seeing a number on a screen, disconnected from the decision that created it. That disconnection is exactly what makes people spend more than they would if they had to hand over cash for every purchase. Now here's the number that puts this into real perspective. Credit card companies generate a massive share of their revenue not from people who pay in full every month, but from a smaller group of cardholders who consistently carry a balance. Those revolving balances, combined with late fees, over-limit fees, and cash advance fees, make up the financial engine of the entire industry. The customers banks profit most from aren't the responsible ones. They're the ones caught in an ongoing cycle of minimum payments and rising interest. Step 4. Your credit limit is designed to tempt you, not protect you. When a bank raises your credit limit, it often feels like a reward for good behavior. But a higher limit isn't primarily about trusting you more. It's about giving you more room to carry a larger balance, because a bigger available balance statistically leads to bigger average debt over time. The limit isn't a ceiling to protect you from overspending, it's a runway. Now you might be thinking, okay, but I pay my card off every month, so none of this applies to me. And if that's genuinely true, you're one of the customers banks make the least money from directly, which is exactly why the entire system is engineered to make paying in full the exception, not the rule. Late fees, minimum payment defaults, complex due dates, and reward structures that encourage overspending all quietly push people toward carrying a balance, even when they didn't plan to. Let me give you an example that makes this click. Imagine two people spend the exact same amount on their credit card every month. One pays it off in full. The other pays only the minimum. To the bank, these two customers are not equally valuable. One is basically a free convenience service. The other is generating consistent, compounding interest revenue for years. The entire design of most credit card products is built around maximizing the second type of customer while making the first type feel like they're using the system for free. Here's the part that should really change how you see this. Credit cards aren't inherently dangerous. and using one responsibly can genuinely be a smart financial tool. But the product itself wasn't primarily engineered for your convenience. It was engineered to make debt feel manageable, purchases feel disconnected from payment, and minimum payments feel acceptable. Because all three of those feelings are what generate the industry's real profit. So the next time you tap your card without a second thought, understand what's actually happening. You're not just making a purchase. You're participating in a system carefully designed to make small financial slips feel harmless in the moment and expensive over years. If you enjoy content like this, make sure to like, subscribe, and join our growing community. Thanks for watching, and comment down what topic or brands we'll next uncover. I'll see you in the next video.